Something big is happening in the global financial system. It's a story that many are missing, a massive shift happening not in the shadows, but right out in the open. For decades, the world has run on one currency, the US dollar. It's how countries trade, what they save, and the foundation of modern economic life. But a quiet rebellion is gaining steam. It's a global movement, fought not with weapons, but with spreadsheets, policy changes, and tons of physical gold. Central banks, the guardians of national wealth, are steadily diversifying away from the dollar. They're looking for ways to reduce their dependence on America's financial system, and their asset of choice is the oldest store of value in human history. This isn't just about money, it's a geopolitical chess match with consequences for everyone. So, who are the players? What are their motives? And what is the strategy behind this massive gold buying spree? Who stands to win? And more importantly, who could lose? There's a quiet rebellion underway. Around the world, a growing number of central banks are making a strategic shift that many in the media are overlooking. It's a widespread move to diversify away from the dollar, and it's happening in plain sight. These countries are moving their wealth into an asset that can't be frozen or controlled by a foreign power: gold. We're going to unpack the geopolitical chess match behind this historic gold rush and reveal who stands to win and who stands to lose. To understand the rebellion, you have to understand the empire. After World War II, the US dollar became king. The 1944 Bretton Woods Agreement made it the world's reserve currency, pegged to gold. Every other currency was pegged to the dollar. This gave America what a French finance minister once called an exorbitant privilege. The US could print money to buy things from the rest of the world, while other countries had to earn their dollars through exports. Then, in 1971, President Nixon cut the dollar's last tie to gold. But the dollar's reign didn't end. It got even stronger thanks to the petrodollar system. An agreement with Saudi Arabia and other OPEC nations ensured that oil, the lifeblood of the global economy, would be priced and traded only in US dollars. This created a massive artificial demand for dollars. Any country needing oil had to get US dollars first, usually by selling goods to America or buying US Treasury bonds. For 50 years, the world has been in this loop: sell real stuff to the US, get paid in dollars, then lend those dollars back to the US government by buying its debt. This has allowed the United States to run huge deficits and pile up a mind-boggling national debt without the consequences any other nation would face. It's the ultimate financial superpower. But now, deep cracks are showing. The first is the sheer size of the debt. As of late 2025, the US gross national debt has surged past $38 trillion. That number is growing at a staggering pace. Over the past year, it increased by an average of $6.12 billion per day. That's $255 million every hour, or over $4 million a minute. For decades, the world was happy to buy this debt. US Treasury bonds were seen as the safest asset on Earth. But trust isn't infinite. Nations are now looking at this trajectory and asking a scary question: is this sustainable? What happens if the world's biggest debtor can't pay its bills, or worse, decides to print its way out of trouble, devaluing the trillions everyone else is holding? This is no longer a distant risk. It's a concern that central bankers from Beijing to Brasilia are having to address. This growing unease set the stage for a change. But it was an act of financial warfare that really lit the fuse. In 2022, following the conflict in Ukraine, the US and its allies took a dramatic step. They froze nearly $300 billion of Russia's foreign currency reserves. With a simple policy decision, Russia's wealth, held mostly in dollars and euros, became inaccessible. For the rest of the world, it was a shocking moment. The message was loud and clear. Your dollar reserves might not be completely under your control. They are not just assets. They could become leverage in a geopolitical dispute. This single act turned a theoretical threat, the weaponization of the dollar, into a stark reality. For any country that might disagree with US foreign policy, holding massive dollar reserves suddenly looked less like a sign of stability and more like a major vulnerability. While not attributed to a single official, the sentiment in many global financial circles was that this was a watershed moment. It was a wake-up call that echoed in central banks outside the immediate Western sphere. The question was no longer if they should reduce their dependence on the dollar, but how. The reaction was a decisive and strategic pivot. Central banks, especially in emerging markets and nations associated with the BRICS group, began a historic shift. The strategy was simple: quietly and persistently reduce dollar exposure and buy gold. Why gold? Because gold is a neutral asset. It's physical, it's finite, and it has no counterparty risk. A gold bar in a vault in your own country can't be frozen by a foreign government or devalued by a foreign central bank's printing press. For many, it's a declaration of monetary independence. The numbers tell the story. In recent years, central banks have been buying gold at a pace not seen in over half a century. The World Gold Council reports that net purchases have been consistently strong, with over 1,000 tons added annually for the last 3 years. This long-term strategic shift has been a major factor supporting the gold price, which hit record highs in 2025. The leaders in this diversification are clear. The People's Bank of China has been a relentless buyer, part of its long-term strategy to internationalize the yuan and insulate its economy. Russia, having learned a hard lesson, continues to add to its gold holdings to make its economy more sanction-proof. But it's not just China and Russia. It's a global trend. Poland's central bank has been a major buyer, with its governor stating a goal of increasing gold's share of reserves to 20%. Turkey, India, and Brazil have also been significant accumulators. A 2025 survey by the World Gold Council revealed the prevailing mood. A record 95% of central bank respondents expected global gold reserves to increase in the coming year. This isn't a fringe movement. It's a new consensus among many of the world's rising economic powers. This gold buying is happening alongside an effort to slow the accumulation of US debt. While the dollar is still dominant, its share of total allocated foreign exchange reserves has been in a gradual decline. At the turn of the century, the dollar accounted for over 70% of reserves. According to recent IMF data, that share has fallen to around 57 to 58%. This is the de-dollarization playbook. Step 1. Slow the purchase of new US debt. Step 2. Use export revenues to buy physical gold. Step 3. Bring that gold home. A 2025 WGC survey showed a notable increase in countries choosing to store gold domestically, up from 41% in 2024 to 59% in 2025. This isn't a chaotic rush for the exits designed to crash the system. That would hurt everyone. Instead, it's a slow burn, a methodical diversification. It's a geopolitical game where the goal isn't to knock the king off the board in one move, but to gradually reduce his power. This is a complex and fast-moving story. The changes we're talking about could affect everything from international relations to your personal savings. If you want to get deeper insights and stay ahead of these shifts, I highly recommend you subscribe to our newsletter. We go into even more detail on these topics, with analysis you won't find anywhere else. The link is in the description below. Now, back to the story. Accumulating gold is only half the story. You can't run a modern global economy on gold bars alone. The second, more complex part of the strategy is to build a parallel financial universe, a system for trade that operates outside the dollar's immediate orbit. For decades, the US has had significant influence over the plumbing of global finance. The main messaging system for bank transfers is SWIFT. Cutting a country off from SWIFT is a powerful tool of financial isolation, creating severe hurdles for its economy. This is another point of leverage that many nations are trying to move away from. The answer isn't one single system, but a network of them. China has developed its cross-border interbank payment system, CIPS, for settling trades in yuan. Russia created its own alternative, the System for Transfer of Financial Messages, SPFS. Now, there are efforts to link these systems. The BRICS bloc, which has expanded to include major energy producers like Saudi Arabia, Iran, and the UAE, is actively exploring payment platforms like Project M-Bridge. This is a blockchain-based system developed with the Bank for International Settlements and now handed over to a group of central banks including China, the UAE, and Saudi Arabia, designed to connect the financial systems of member states for trade in local currencies. The immediate goal isn't to create a single BRICS currency overnight. The more realistic plan is to create a system where member countries can trade with each other directly, using their own currencies. So Brazil could buy from China and pay in yuan or reais. India could buy oil from Saudi Arabia and settle in rupees or rials. This is already happening. The share of China's yuan in Russia's foreign trade settlements has surged, with some reports indicating over 90% of their bilateral trade is now settled in yuan or rubles. India is also paying for some of its Russian oil imports in currencies other than the dollar. But what about trade imbalances? This is where gold could re-enter the picture, playing a potential role as the neutral settlement asset. The long-term vision is a world where major imbalances between these nations might one day be settled not with US dollars, but with transfers of gold. Gold could become the final arbiter of value in this new, multipolar financial world. Think of it this way. The dollar system funnels most global traffic through a single, US-influenced highway. These emerging nations are building a network of local roads for trade among themselves. And for the major intersections connecting these roads, the traffic lights could eventually be backed by gold. This doesn't mean the dollar will disappear. It will almost certainly remain a major currency. But its exorbitant privilege would be challenged. Its role could shift from a global monarch to more of a regional power in a world with multiple economic poles. The foundation for this new world is being laid now, with local currency trade, alternative payment systems, and a massive strategic stockpile of gold. So what happens if this strategic shift away from the dollar continues? Who are the potential winners and losers? The most obvious nation facing a challenge is the United States. A reduced role for the dollar could mean the end of the exorbitant privilege. The ability to finance huge deficits by having the world buy its debt could be diminished. Imagine the US government trying to borrow and finding its biggest historical customers are less interested, or are demanding much higher interest rates. This could create tough choices: drastically cut spending, raise taxes, or pressure the Federal Reserve to create more money, which carries inflationary risks. The cost of imported goods could rise, and the era of cheap credit could fade. Furthermore, America's geopolitical power could be affected. The ability to use financial sanctions as a foreign policy tool is less potent in a world with viable alternatives to the dollar. The winners, on the other hand, would likely be the nations leading this change. The BRICS countries and other emerging economies could gain more economic sovereignty, making them less vulnerable to US policy shifts. By trading in their own currencies, they could foster stronger regional ties. For an energy producer like Saudi Arabia or the UAE, selling oil for yuan or other currencies diversifies their customer base. For China, a more international yuan is a cornerstone of its global ambition. For Russia, it's a matter of economic survival, a way to build a sanction-resistant economy. For the global financial system as a whole, the transition could be volatile. A gradual shift to a multipolar currency world might be more stable in the long run by spreading risk. But getting there could be rocky, with currency fluctuations and economic uncertainty. And what about the average person watching this unfold? The implications are profound. Holding all your wealth in a single currency, especially one facing a changing global landscape, carries risks. The actions of central banks, the world's largest and most conservative financial players, offer a clear signal. They are diversifying to manage risk, moving into neutral, hard assets like gold. This doesn't mean you should run out and convert all your savings to gold, but it does highlight the timeless importance of diversification. The winners in this new era will be those who understand the shifting landscape and position themselves accordingly, recognizing that the very definition of a safe asset is being reevaluated before our eyes. The strategic shift away from the dollar isn't a secret plot. It's an observable trend driven by nations representing a large portion of the world's population. It's a logical response to the challenges of a system built on ever-increasing U.S. debt and the use of financial access as a tool of statecraft. This isn't a story about an overnight collapse. The dollar's dominance is deeply entrenched. Unwinding it won't happen in a month or a year. This is a slow burn, a gradual shift that will likely play out over the next decade. But the game is in motion. The strategic accumulation of gold by central banks is the most visible sign. The development of alternative payment systems and the rise of bilateral trade in local currencies are the crucial maneuvers happening behind the scenes. Together, they represent a growing desire for a more diversified global financial system. We are living through a pivotal moment in economic history, a potential transition from a unipolar, dollar-centric world toward a multipolar world with multiple centers of economic gravity. The final outcome isn't written, but the direction of travel is becoming clearer. The shift is real, the movement is underway, and the global financial system is changing. Thank you for watching. If you found this analysis valuable, please hit the like button, and be sure to subscribe and turn on notifications so you don't miss our future updates. What are your thoughts on the future of the dollar? Let us know in the comments below.